Netflix is scheduled to report fourth quarter 2024 financial results after the markets close on January 21st, 2025, which has investors asking if they should buy Netflix stock before the company announces those earnings. The reason investors like to get in before earnings because earnings tend to be a volatile event that sometimes sends stock prices higher by 20, 30, sometimes even 40 or 50%. And so investors like to get in before that because they don't want to miss out. I don't generally condone such action trying to time the market, but I do understand that investors have questions and concerns about when to buy a stock. So I'll address those concerns and I'll answer that question in this video here by evaluating Netflix stock.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Netflix last reported results on October 17th, 2024. And there was a lot of good things to like about that report. Netflix said that they delivered on their plan to re-accelerate the business, and they're excited to finish the year with a strong and great fourth quarter slate of content, including Squid Games 2, the Jake Paul and Mike Tyson fight, and 2 NFL games on Christmas Day. By all forms of measurement, these 3 were great successes. In fact, the Jake Paul and Mike Tyson fight was so popular that the website, the app was stalling or lagging because there were so many people watching the event. And Squid Game and the NFL games on Christmas Day were known to be very popular events. It'll be interesting to see if Netflix releases numbers on these events when the company reports their financial results on January 21st. So Netflix is forecasting revenue of $10.1 billion for the fourth quarter, which would represent 15% growth year over year. They're also forecasting an operating profit margin of 21.6%, which would be a huge improvement from the 16.9% they reported in the same quarter the prior year. In fact, management has said several times this year they're surprised at how much their profit margin expanded, and they're going to use some of that to invest it back into the business in 2025. They want to balance that, right? They don't want to harvest profits too quickly without investing sufficiently in the growth of the business. And so when your margins are better than expected, that gives you an opportunity to invest in some areas that you might have been putting off or you might have been delaying and saying, let's do that later when we have more money. This is the time to do it for Netflix because they have more money. They have a lot more than they expected to have. And so it's going to be an opportunity to invest in some of these initiatives that they've been putting off for a little while. Netflix reported cash flow from operating activities of $2.3 billion in the most recent quarter. And compared with the same quarter last year, that was up by around $330 million. Netflix has done a great job increasing cash flow, increasing free cash flow, while at the same time spending over $15 billion consistently annually on content. This is a business that benefits from economies and scale, and they've demonstrated that as they've grown larger, their operating margins have expanded. Furthermore, I've been impressed with Netflix's decision-making over the last 5, 6, 7 years. They've faced a number of challenges, and in my opinion, they've handled them well. One of the challenges was that, let's say 5, 6 years ago, maybe 7 years ago, when many of their partners, their content distributing partners, started to open or be interested in starting their own streaming service, they were withholding content from Netflix and they were saying, we're not going to sell you content anymore because we want to keep that for our own platform. And so there was a lack of content at Netflix. Netflix countered by increasing the budget for original content, and I've thought that they did an excellent job with that. The content that they've been creating, hit after hit after hit, you can think about all of the popular titles Netflix has created in original series and movies, etc., they've demonstrated great skill in creating content effectively, not wastefully. Arguably, I would say Netflix has been the best in the last decade at creating content effectively, right? Some of these studios might create a better movie, or they might create a movie that does 2 billion in sales at the box office, but you don't think about all the other movies that they spent hundreds of millions of dollars on and then marketing it for another couple of hundreds of millions of dollars to see those results in the theaters. Netflix, on a relatively smaller budget per movie, right? They spend more than some of these studios on content creation, excluding sports, but the budget per movie or the budget per series might be lower than some of these big hits or big budget creations you see at legacy studios. Then, another thing I thought Netflix did effectively is facing competition during COVID, when all of these competitors, everyone and their cousin wanted to start a streaming service, and everyone came in, and Netflix handled it extremely well. Rather than panicking and offering incentives and promotions and lowering its price to try and keep customers, Netflix did the opposite. They raised the price of their service, confident in their content, confident in the value they offer their customers. They raised prices consistently and withstood that competition and came out still ahead, well ahead, and even further ahead than the competition before the pandemic. So I could go on about the several things that Netflix has done well and done effectively. I've been bullish on Netflix stock for several years now. I believe it was rated as one of my top stocks to buy last year. I still have the stock rated as a buy this year, even though I don't have it rated as one of my favorites. It's because the stock price had gone up by so much already that I see others as perhaps a better value, but I'm still very bullish on Netflix as a business. So the valuation now, they're trading at a forward price to earnings of 29, which is at about the midpoint of where it's traded at in the last 3 years or so. It's been higher, it's been closer to 40, and it's been lower. It's been closer to 20 and closer to 15. So at 29, it's about at the midpoint, a little bit above the midpoint. And then I've also done a discounted cash flow model on Netflix stock. And according to my intrinsic value at $826 a share, the current market price is $828 a share. So it's about fairly valued right now. But I like to say a lot that I don't mind. In fact, I would love to pay a fair price for an excellent business. And I do believe, and I have seen, that Netflix is an excellent business. So I'd love to pay a fair price for an excellent business. That's why I have Netflix stock rated as a buy. Now, the question as to whether or not to buy it before earnings or after earnings, it depends on your risk tolerance. If you're a risk-seeking individual, meaning you want more risk, then by all means, buy the stock before earnings. If you're risk intolerant or you like to avoid risk, then it's less risky to buy the stock after earnings. In fact, it's actually the least risky to, well, I don't want to say least risky. It depends on the type of risk, right? Because there's two sides of risk. There's the risk of missing out and there's the risk of losing your money. So if you want to balance all of those risks, then you take your amount that you wanted to buy. Let's say you wanted to buy $1,000 worth, and you split it in half and you buy $500 before earnings and $500 after earnings. That's the way to balance all the risks on all sides, both of missing out and of the downside. Longer term, though, zooming out and looking at it as a long-term investor, it's an excellent business selling at a fair price.
Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.